Hi, Sindre here, Associate Professor in Industrial Economics, and I want to talk about net present value. And I want to explain the concept extremely slowly, really slow. So if you want a quick and dirty explanation, you can always just go to something like Investopedia and look it up. But I teach this concept to students. I have about 300 of them every single year. And there are a few things there that many of them seem to misunderstand. So I want to go slowly through it and try to address some of the most common things that causes confusion. So first of all, very fundamentally, net present value is a tool that comes from business economics that can assist us in making decisions. Binary decisions in terms of whether or not we should undertake an investment or a project. And just briefly, for me, investment, project are basically synonyms there, so I'm going to use them interchangeably. So a decision-making tool to help us determine whether or not we should do a project or if we should not. At least it will lend assistance to such a decision. But very fundamentally, net present value is essentially nothing more than just a very simple cost-benefit analysis. We are comparing the pros to the cons, the advantages to the disadvantages, the benefits to the drawbacks, and whatever synonyms you want to use, like utility versus the disutility from taking the project or investment. And we want to make sure that the advantages or the benefits are outweighing the disadvantages, the drawbacks, the disutility. That's basically what we want to do here. It's just a cost-benefit analysis. However, there's a problem when it comes to making a pros and cons list or listing up the advantages versus the disadvantages. There are at least three problems that you kind of need to solve. And net present value is kind of giving an answer to these three issues that I'm thinking of. But there are alternative answers that you could give to these issues. But so what are the issues? First of all, you need to have some kind of measure, some numeric way to quantify the advantages and disadvantages. Otherwise, you wouldn't really be able to compare them. So for instance, imagine if you are in a love triangle and you're not sure who you're going to date. So you're going to date Andy, who is very good looking, or are you going to date Ben, who has a very career prospect? But maybe Andy knows how to play the guitar, but Ben is taller. Advantages, disadvantages. Like, how do you compare them? So you need to find a common measure that you can use, so it enables you to compare advantage with disadvantage. And in net present value, the way we measure the benefits and the drawbacks is with money, with monetary units, or whatever currency you prefer. It could be in dollars, could be in pounds, could be in Norwegian kroner, or whatever you prefer. So in net present value, we compare advantages, disadvantages, but we translate this into numbers, into money. So that's the first issue, and the first answer to that issue. Measure it in terms of money. The other fundamental problem really with the cost-benefit analysis is that you need to have an answer to whose perspective are you looking at. Because an advantage for me might be a disadvantage for you, right? So if you're playing chess, a good move for me, or going to put you at a disadvantage. So we need to answer here who exactly are we counting the benefits for. From whose perspective is this an advantage? And in that present value, the answer is the shareholders of the company. We adopt what's called the shareholder perspective. So in business economics, there are basically two perspectives, fundamental perspectives. You have the shareholder perspective and you have the stakeholder perspective. So the shareholder perspective basically just means that you want to maximize the amount of money that goes to the shareholders, and you don't really care about any kind of externalities. So if you are creating pollution, for instance, like that, you don't want to take that into consideration because of externalities. So this is a problem with net present value, or not necessarily a problem, depending on what you think about this in political terms. But it is something that present value has been criticized for, that is only adopting the shareholder perspective rather than stakeholder perspective, which is more broader that tries to look at the whole of society, do what's best for society as a whole rather than doing what's best for one particular company and its set of shareholders. But that is what it is. This is just like what net present value assumes. You're trying to maximize the amount of money that goes to the shareholders. And the third problem that you can kind of have with cost-benefit analysis is that you need to think about the time perspective. An advantage for me in the short run might actually be a disadvantage in the long run and vice versa. So you kind of need to have an answer here to what kind of time perspective you are looking at. And net present value is kind of elegant in this way that it finds a way to to adjust or take into consideration different time perspectives. That's called the time value of money, and I'm going to get back to that later on. Okay, let's look at the equation for net present value. Or more specifically, let's start with something that isn't the equation for net present value and slowly turn it into the equation for net present value. So first of all, net present value being like this cost-benefit analysis where we measure everything in terms of money, you would think that it would just be the difference here between the income and the cost. So NPV equals income minus cost. That is almost correct. At the core of it, we got many things right there, but like a few details that I want to change. So first of all, we're not going to look at every possible income and every possible cost. There are going to be two restrictions basically. So we're going to look only at a subset of the income and subset of the cost. So in no particular order here, first of all, we're not actually looking at, as I said, all possible types of costs. We're only going to look at the cost that causes any kind of cash outflows. And we're not going to look at all possible incomes either. We're only going to look at the types of income that causes an inflow of cash. So you only consider incomes and costs when they actually causes money to come into the company or leave the company. Only when money is transferring hands do we consider it. So for instance, if you have some inventory, a piece of machinery, it will be depreciating over time. So accounting wise, you do have a cost there, reducing the value of the inventory, but that doesn't actually causes any money to leave the company. It's just like in the accounting. So it doesn't actually cause a change of cash. So we're not going to consider depreciation, for instance. So that is one restriction that I have here. The other restriction that I have is that, or not me though, but like the theory of net present value, the other restriction is that you're only going to look at cash inflows and cash outflows that are caused by the project. So if cash inflow or cash outflow were to happen regardless of whether or not you undertake the project, then you would not consider it. So the equation is not going to be income minus cost, it's going to be cash inflow minus cash outflows. So that's one change you need to make before we get to the net present value equation. Another change I want to make here is that I want to spread it across like a timeline, because later on I want to adjust for when the cash inflows and cash outflows are occurring. So imagine a timeline here that represents for how long the investment or the project is active. So the timeline goes from time period 0 all to time period capital T. So at every time period here, there's going to something's going to happen in terms of inflows and outflows. And once you reach after capital T, there's not going to be any more change of cash. No more cash coming in, no more cash coming out. So everything is going to happen in this time period. So taking this timeline into consideration, the equation becomes more something like this. So a summation sign here from lowercase t equals 0 all the way up to uppercase t for cash inflows, and the same for cash outflows. This is a little bit cumbersome, of course, to have two summation signs. So what you can do is to merge them together, just one summation sign. And also having this inflows minus outflows is also a bit tedious. So what you can do is just to substitute cash inflows and minus cash outflows with cash flow. So a cash flow is equal just to the difference between inflow and outflow. So this right here is almost going to be the net present value equation. There is, however, just one more thing we need to change before we finally have the net present value equation. Specifically, that is that we somehow need to take into consideration the time value of money. Now, there's a lot of confusion when it comes to the time value of money. Some say that has to do with need to adjust for the time preference that people have, because people prefer to have money now rather than later. Some say no, this is about the earning potential of money, because with money you can earn more money. And some say no, this actually has to do with the alternative cost. And all of these things are actually correct. They are not contradicting or different things, which it might look like at first glance. They're actually like basically just the same things stated differently. So imagine it like this. Would you prefer to have, this is the classical example. If you learn anything about net present value, you probably haven't given this example. But your grandmother comes and asks you, do you want to have $100 right here, right now? Or do you want to get them in 1 year from now? What would you prefer? You're supposed to say, of course, you want them right now. But why is that? Well, that is because you could take this $100 right now, put them in the bank for some kind of interest rate. Let's say it's 1%, and after a year you will have $101 versus just getting $100. So there's kind of an earning potential there. With money, you can do stuff with money. You can put in a saving account, you can invest it. So with that money, you can earn more money. That is a problem. So the earning potential of the money, that is something we need to correct for to make sure that we are comparing apples to apples and bananas to bananas, and not avocados to peaches. We need to make sure we are comparing the same thing. So we want to adjust all of the cash flows that happens at different points in time into be at one point in time, so they become comparable. And the way to do that is basically to discount every single cash flow. And the way to discount the cash flow, we need to take the present value. And the present value is essentially just the exact opposite of taking the future value. So that was a lot of terminology. So let me demonstrate. Okay, so consider this example. You receive $100 today, and you're going to put it into the bank for 10 years. And you receive an annual interest rate of 5%. How much money do you have after 10 years? And the interest, put that back into the bank, so compounding interest rates. That number we're going to get is called the future value of the $100 we received today. So you probably know this already, but that's going to be like $100 multiplied by 1 plus 5%. To the power of 10. That is equal to approximately 162.89. So this $163 is the future value of the $100 received today. Okay? So the opposite of a future value is the present value. So imagine that 10 years from now you're going to receive approximately $163 in 10 years, I said. The interest rate is 5%. What would the value be today? What is the present value of some money received in the future? How much is that money worth today? So not about inflation, this is only about the earning potential. Well, to find that, you do exactly the opposite. It's going to be $163 multiplied by this fraction between 1 and 1 plus 5% to the power of 10, which is going to be $100. So future value and present value is kind of the opposite operations here. So what we're going to do with the net present value equation is to replace cash flow of a time period t with cash flow of a time period t divided by 1 plus r to the power of t. And that is the equation for net present value. Very nice. So I think we need to explain more what's going on there. Replacing cash flow with the present value of the cash flows, or discounting the cash flows, that is what we mean by adjusting for the time value of money. And the reason we are doing this is because money can be used to earn more money. Money has an earning potential. And that earning potential is represented with this interest rate R, which we call the discount rate, or the hurdle rate. or the cost of capital. So many different names there, but usually we refer to it as the discount rate. And this discount rate here, as I said, that represents the earning potential of money. So if you're a kid and you got $100 from your grandma, there isn't really much you can do other than just put it into the bank. Maybe that's the best thing you can do. But if you are a company, you have better alternatives. You're going to use something else rather than just the interest rate in a saving account. So the discount rate is going to be equal to the best possible utilization of that money if you couldn't do the project. So what's the highest interest rate you can get from investing this money? And for companies, we use a formula called WACC, which is an acronym for Weighted Average Cost of Capital, which basically just take the weighted average share of the cost of debt, which is going to be like the interest rate that the bank charge you for loaning money from them. I'm just going to take a look at the cost of equity, money that comes from the shareholder in a company. So this is quickly going to get very complicated. The cost of debt is pretty simple to find, but the cost of equity is a lot more complicated. But the point of departure and the simplest model for finding the cost of equity, that is the capital asset pricing model, which looks like this. You see the risk-free in there, is the market portfolio, and there is this beta coefficient in there, which is the covariance or the ratio between the covariance and the variance. So between the return on the share and the market portfolio. So that's basically the output of a simple ordinary least square regression. That is just univariate, so that's why it's been criticized. You need to put in more factors there, and it becomes more complicated. So finding the actual discount rate is actually quite complicated. But discount rate represents the earning potential of the money. Like, what's the highest interest rate you can get for this money? So taking the time value of money into consideration means that we need to discount all the cash flow by this discount rate, taking the present value. So that is basically what is going on in net present value. Net present value is just a cost-benefit analysis that takes into consideration the time value of money. It's a little bit, a lot of words inside. It quickly becomes like a word salad. The reason that people talk about the alternative cost is that has to do with the discount rate, because the discount rate is set equal to the best alternative utilization. So congratulations, now you have the net present value equation. However, there is still one more thing I want to say about this equation. That is, maybe you have seen it look a little bit different. Rather than the summation sign going from time period 0 all the way to capital T, instead it goes from time period 1 to capital T. The initial cash flow, cash flow of time period 0, is put outside of the summation sign and is replaced with just the investment cost, because we assume that the cash that happens right here, right now, when you undertake investment, that's the investment cost, the money you invest into some kind of project. And here is very easy to step into the salad, and that is because people confuse the concept of a cash flow with that of the investment cost. The cash flow is a number that you always add, because a cash flow can be positive and it can be negative and it can be 0. A cost, however, an investment cost, can never be negative, because if the cost is negative, that would mean that it's not that you have to pay the bill, it's that someone is paying you money. So you don't have negative costs. Costs are always positive numbers that you subtract. So you get this funny relationship here between the cash flow and the investment cost. So that is something that you need to keep in mind to not get confused by. So this is basically how the net present value equation is usually represented. It's the discounted sum of all future cash flows minus the initial cash flow, which is the investment cost. And that is why it's called net present value. It's the present value of all the future cash flows net, minus net of the investment cost. So there you go. Here's the answer. This is the equation for net present value. Very nice. So now that we have explained the net present value equation, we need to talk about what exactly does the output of this equation actually mean. So the output is going to be a number such as 50,000, and that's going to be in some kind of currency such as dollars. So the question really is, what exactly does $50,000 mean when that comes out of the net present value equation? Well, what it means is that the moment you decide to undertake this particular project, the value of the company will instantaneously increase by $50,000. So net present value is by how much the value of the company will increase if you decide to take on the project. That is easy to say, but I think we need to dwell a little bit more into why that is the case, how this happens. So you probably are familiar from the corporate finance courses that the value of a stock is often has the equation the dividend divided by R, the interest rate. Actually, let's take a step back here. The fundamental purpose of a company, a stock company that's listed on the stock exchange, is to maximize its enterprise value, the value of the company. And that again, that's come from the shareholder perspective. If you have the stakeholder perspective on the companies, then that's not going to be the goal of the company. But if you have the shareholder perspective, the ultimate goal of a company is just to increase the value of the company. And the value of the company is, you need to multiply two things together. The price of the stock multiplied by the number of stocks. The number of stocks is kind of a static thing, so we don't need to talk about that. But the value of, or the price of a stock, that's determined in the stock exchange by supply and demand, that sort of things. But the fundamental value of a stock comes from the dividends. So when you own a stock, the company, if they feel like it, decide to pay out a dividend, which means that they pay you a certain amount of money depending on how many stocks you have. So that is kind of like a cash flow thing. So if you were to sum up the present value of all the dividends that you will ever get from owning that stock, then that would actually be equal to the value of the stock, the price of the stock. And sometimes we simplify by saying that okay, maybe the dividends is going to be the same number every single year for some kind of interest rate. Well, then it's simplified into becoming dividend divided by the interest rate. So the discounted sum of all dividends is equal to the price or the fundamental value of the stock, which is going to be the stock price. However, the dividends, they come from cash that the company has available. So if you think about it, the only two things that a company can do with this cash, it can either pay it out as dividend, or they can reinvest it into the company. So if you just look at a sufficiently long time period, and all the way until the company eventually goes bankrupt, all the cash has to eventually be paid out as dividend. So you could just say that the value of the company is just the discounted sum of all the cash flows they will ever earn. So essentially, the value of a company is going to be the sum of all the investments that the company is ever going to undertake. So when you take on a project and its present value, that is kind of overlapping. These two equations are overlapping. The value of the company is just the sum of all the net present values of all the projects they were going to do. So that is why when you undertake a project with a positive net present value of 50,000, the value of the company will increase by 50,000. So that's where it comes from. So that is kind of cool, I suppose. So once we know this, that makes it very easy for us to understand the decision-making rules for net present value. And that's what we're going to talk about next. So the thing about the decision-making rules, basically when should you accept a project, when should you reject it based on net present value, it kind of depends on the scenario. There are different scenarios you could encounter. And I will talk about the 3 most common type of scenarios that you will encounter, not in real life, but that you will encounter in curriculum books and in courses where you learn about net present value. So since net present value kind of represents how much the value of the company will increase if you take the project, it makes sense that based on net present value, you will never accept any project at negative net present value. So that has to be our point of departure. You should only accept a project if it has a positive net present value. So that is a necessary condition, but it's not a sufficient condition. There is more to it depending on your scenario. So if you have a scenario where you have an infinite amount of capital to invest, that's silly, that's never going to happen in the real world. If you have an infinite amount of capital, you would never bother with investing in the first place. But that's just what we usually assume in these courses and these curriculum books about net present value. If you have an infinite amount of money to invest, and there's no restriction on how many projects you can take, the decision-making criteria is basically just this: accept every single project that has a positive net present value. Because if you accept a project with positive net present value, the value of the company will increase. And your goal as a company is just to maximize the value of the company. You also have like the extreme opposite here, that you still have an infinite amount of capital, but there's some strange restriction that means that you can only invest in only one single project. Once you select one project, you need to reject all other projects. That's another common scenario that you will encounter in the curriculum books. Why that will be the case is hard to say, but maybe you have restriction in terms of person power or time. For instance, if I'm going to go to the cinema and can choose between 2 movies, I can only go and watch one movie. I cannot do both of them, even though I have enough money to watch both movies. My time is like the bottleneck here. That's why. So there could be some kind of restriction like that. But if you have multiple projects to choose from and you can only select one, and you have an infinite amount of capital, well, obviously you're just going to select the project with the highest net present value. It's not going to be sufficient for a project that has positive net present value. You need to pick the one with the highest net present value, conditional on it still being positive, of course. You're not going to take the highest net present value and it's a negative number. You're not going to do that, of course. A more realistic scenario is that you have limited capital. You have a portfolio of different investment opportunities, but you have restriction on how much you can invest. But you can assume that there is no other restriction, so you can take any combination that you want. Well, again, still, you're never going to take a project with negative net present value, but now it actually becomes more complicated. Many would suggest that you have some kind of greedy algorithm and that you just sort the projects from the highest net present value to lower and lower and lower in descending order, and you start at the top and invest until you run out of money. Now that's a so-called greedy algorithm, and that is not necessarily going to give you the best solution. You could just end up on a local optimum. So what you basically have to do is trial and error. Just try out every single possible combination of projects and see which one maximizes the net present value, conditional on not exceeding the budget constraint. So it's going to be really tedious and difficult to do that with pen and paper for any example that is not just like a simple Mickey Mouse example. But it's really easy to do this in Excel with the solver. So basically, you just have to try out every single possible combination there and see when you maximize the net present value. So those are like the 3 scenarios there. And many students are struggling with this because it seems like the rules are, in conflict with each other. They differ. They are. Sometimes you need to take the highest, and sometimes you ignore the highest. But it all makes sense once you realize what net present value is. It's just the amount of money that the company will increase in value when you undertake the project. So once you know that, I think it's really easy to understand all of the decision-making criteria. One very, very final topic to talk about here when it comes to net present value will be to discuss the effect on net present value by changing any of the input variables. I'm actually just going to skip that. You can just read my lecture note if you are a student in my course. But essentially, the input variables of net present value is the cash flows themselves. So what happens to net present value when you change the cash flows? Well, if you increase the cash flow, the net present values go up, obviously. If you decrease it, the net present value goes down. So that's pretty straightforward and obvious. By how much? Well, it kind of depends when the cash flow occurs. Two other variables, it's the discount rate and the timing of the cash flows. And for the timing and the discount, people or many students actually get this wrong. Many students seem to believe that if you increase the discount rate, then obviously net present value must go down, so kind of an inverse relationship. But that is not necessarily true. That is only true if all the future cash flows were positive. If you increase the discount rate for a positive cash flow, then its present value will decrease. So the present value becomes lower and lower and lower for a positive cash flow the more you increase the discount rate. However, a negative cash flow will not become lower and lower. Its present value will actually increase. So the way I think about this is that if you have the number line and you have a positive cash flow, negative cash flow, and you have zero in the middle, then as you increase the discount rate, they're going to get both pushed towards zero. So positive cash flows decrease in their present value, and negative cash flow are actually increasing in present value. That is something that many are overlooking. So that means that you're not going to know for sure what happens to the net present value if we change the discount rate, unless we actually go there and calculate and look at all the calculate the specifics. Because if you have a combination here of positive and negative future cash flows, which could be the case if you have like a decommissioning cost at the end, then you might not get a monotonically declining relationship between net present value and discount rate. So if you have net present value on the y-axis and discount rate on the x-axis, you could actually get an inverted U-shape, like a concave function. That could happen. So you should not be too hasty to conclude that net present value goes down the moment discount rates go up. That's not necessarily the case. And similarly for the timing, if you postpone a cash flow, its present value will go down if it is a positive cash flow, but it will go up if it is a negative cash flow. And all of this, we could derive this, but I'm just going for the intuition here. So a way to think, so in summary, in conclusion, when it comes to the timing, if you owe your friend some money, or if your friend owes you some money, insist that they pay you immediately. If you owe your friend some money, then try to postpone your payment for as long as possible. So the effect of timing and of the discount rate is not as straightforward as it might seem initially. So that's going to be it for me. That was like a few details about net present value that I felt like talking about. If you want to know how to actually calculate it in practice using Excel, I have another video about that. There's more details to what I said today in the lecture note. So yeah, that's it for me. I'm gonna go home now.